Taxes are actually a powerful tool, but here's the catch. Timing matters. A lot of folks think, I'll just deal with my taxes in April. That's when they're due, right? By the time April rolls around, your opportunity to make the most of these money-saving moves is gone, vanished. The window has closed. December 31st is the real deadline for most tax strategies. If you're waiting until spring to start thinking about this stuff, you're leaving money on the table, money that could have stayed in your pocket. You're listening to Everyone's Talking Money, the show that's all about making life richer. Whether you're here to crush debt, build wealth, or finally feel in control of your cash, you are in the right place. Did you know that every single year, millions of people give the IRS an interest-free loan without even realizing it? You're listening to Everyone's Talking Money, the show that's all about making life richer, from your bank account to your mindset and everything in between. Whether you're here to crush debt, build wealth, or finally feel in control of your cash, you are in the right place. Let's dive in and get you living life on your terms. You are one conversation closer to financial freedom. Hey there, welcome back to Everyone's Talking Money. I'm your host, Shari. Yes, you heard that right, an interest-free loan to the government of all people. This is episode 2 of our Smart Money Moves before year end. And today we're talking about tax moves that pay off, how to keep more of your money before December 31st. Here's the good news, and I mean really good news. You still have time to fix that problem before the ball drops on New Year's Eve. And I get it. When you hear year-end tax planning, your brain probably goes straight to boring spreadsheets, complicated jargon, and that one time you fell asleep during a conversation about tax deductions. But here's the thing. What if I told you that a few simple moves you can make in the next few weeks, could save you hundreds, maybe even thousands of dollars? And no, you don't need a CPA on speed dial to do it. This episode, I'm breaking down the year-end money moves that can help you keep more of what you've earned. We're talking retirement accounts, smart giving strategies, sneaky tax benefits you're probably forgetting about, and yes, even how to make your losses work for you instead of against you. So grab your coffee, pull up your banking app, and let's get to it. Because you can't time the market, but you can time your tax bill. All right, before we dive into the actual strategies, we need to talk about something that might feel a little uncomfortable at first. Your relationship with taxes. Now, I know what you're thinking. Relationship? I don't like them. I don't like it. And I avoid them until April, and then I start panicking. And honestly, you're not alone. Most people treat taxes like that one friend who only calls when they need something. You dread the interaction, you procrastinate the conversation, and then when it finally happens, you're stressed, scrambling, and wondering why you didn't deal with it sooner and just get it over with. But here's the mindset shift I want you to make today. Taxes aren't just this annoying thing that happens to you once a year. Taxes are actually a powerful tool. And when you use that tool intentionally, when you make strategic moves before the calendar flips, you're not gaming the system, you're just being smart. Most of the year-end moves we're going to talk about today aren't loopholes. They're not sketchy. They're literally strategies that the government wants you to use. They're built into the tax code to encourage certain behaviors, like saving for retirement, giving to charity, and investing in your health. But here's the catch, and this is the part that trips up people every single year. Timing matters. See, a lot of folks think, I'll just deal with my taxes in April. That's when they're due, right? And technically, yes, April 15th is tax day. But by the time April rolls around, your opportunity to make the most of these money-saving moves is gone, vanished. The window has closed. December 31st is the real deadline for most tax strategies. That's the date that counts for the IRS. So if you're waiting until spring to start thinking about this stuff, you're leaving money on the table, money that could have stayed in your pocket. I used to do this as well. I'd file my taxes, I'd wait for my accountant to perform some magic, and then obviously when he didn't, I was frustrated and annoyed. But that's like driving a car looking in the rear view window. When you're filing your taxes after the fact and you're kind of expecting some magic to occur, it's not realistic. You need to make the moves in the year that you're filing your taxes for, not waiting until April for some magic calculation or for some magic deduction to appear. Today, we're flipping the script. We are not waiting until we're stressed or scrambling. We're getting ahead of it. We are not procrastinating. We are taking control. And we're doing it in a way that actually feels good. Because let's be real, keeping more of your hard-earned money always feels good. Now, I do have to say, I am not an accountant. I am not a tax professional. So please, any ideas that you're getting from my show today, take them to your accountant or tax professional and talk them out. See if they apply to your particular situation. This episode is just for some ideas that you can implement, and then go to your professionals and make them happen for you. Okay, so let's jump into smart move number 1. And honestly, this is a big one. If you only do one thing before December 31st, make it this: max out your retirement accounts. Now, I know max out your retirement account sounds like advice your dad would give you at Thanksgiving dinner when he's carving the turkey, but stick with me, because this move is both a tax break and a retirement raise, all wrapped up in one beautiful package. Here's how it works. When you contribute to a traditional 401k at work or a traditional IRA on your own, you're putting in pre-tax dollars. That means the money goes into your retirement account before the IRS takes their cut. So if you make, let's say, $60,000 a year and you contribute $5,000 to your 401k, your taxable income drops to $55,000. You just saved yourself from paying taxes on that $5,000. Boom, instant tax reduction. And here's the kicker. That money still belongs to you. It's not gone. It's just sitting in your retirement account, growing and compounding so that future you, the one sipping margaritas on a beach at age 67, gets to enjoy it. Now, let's talk deadlines though, because this is where a lot of people get confused. For your 401k, contributions must be made by December 31st. That's a hard stop. If your employer takes it out of your paycheck, you need to make sure that last paycheck of the year reflects your contribution. If you want to bump up your contribution percentage, now is the time to log into your HR portal and make that change, because odds are it's going to take a pay cycle or two to get implemented. And then we're in November. We're almost to the end of the year. For your IRAs, your individual retirement accounts, you actually have a little bit more breathing room. You can contribute to an IRA all the way up until April 15th of the following year, and it still counts for the previous tax year, meaning you don't have to contribute to your IRA until you actually file your taxes. So technically, you have until April 15th, 2026 to make a 2025 IRA contribution. But here's my advice. Don't wait. Life gets busy, money gets spent. If you have the cash now, put it in now, because if we wait, it's likely not going to be there when we need it. Here's another beautiful thing about the 401k, the employer match. If your company offers a match, and a lot of them do, that's literally free money. It's like your employer saying, hey, for every dollar you put in, we'll throw in 50 cents or $1 or 75 cents. Whatever their match formula is. Sometimes it's a little convoluted what their match formula is, but just find out how much do you need to put into your 401k or 403b to get 100% of the match. And yet, so many people leave that money on the table. Don't be that person. If your employer matches up to, say, 6% of your salary, make sure you're contributing at least 6%. Anything less, you're walking away from free money. Now, I get it. Not everyone can max out their 401k in the traditional sense. In 2025, contribution limit is $23,000 for people under 50 and $30,500 if you're 50 and older. That's a lot of money. If you can't hit that number, that's totally okay. Because also you will have other goals you're saving for. You need to fully fund your emergency fund. You're saving to buy a house. You're saving to make improvements to your house. You're saving for vacation. So we also don't want to fall in the trap of putting all of our money into retirement that we can't use until we're older than 59 and a half. But what you can do is increase your contribution by just 1 or 2% before the end of the year. So let's say you're currently contributing 5% of your paycheck. Bump it up to 6 or 7%. You're probably not even going to notice the difference in your take-home pay. But over the course of a year, especially over the course of a lifetime, that small change adds up in a massive way. So here's your action step for smart move number 1. Log into your 401k or 403 account this week. Check your contribution rate. If you can, increase it by 1 or 2% before December 31st. And if you haven't opened up an IRA yet, look into it. You have until April to contribute. But again, don't wait. This is your tax break and your retirement raise all in one move. Don't sleep on it. Smart move number 2, harvest losses, not regret. This might sound a little counterintuitive at first, but trust me, this one's a game changer if you have a taxable investment account. That means it's not IRA money, it's not Roth money, it's not retirement money. It's like that money that's after tax that you invest, but again, it's not in your Roth IRA. It's in a brokerage account, it may be called. It's in an individual account, could be another name for it, or it's in a taxable account. All of those different names mean you are paying taxes on the earnings you generate that year if you have a gain. Now, conversely, if you have a loss, you could do what's called tax loss harvesting. Say that 3 times fast. And no, it's not some complicated Wall Street term that only hedge fund managers understand. It's actually pretty simple once you break it down. Here's the idea. Let's say you invested in a stock or fund earlier this year and it didn't perform the way you hoped. Maybe you bought it at $100 a share and now it's sitting at $80. That's a loss of $20 per share. Bummer, right? Yes, but maybe no. Here's where tax loss harvesting comes in. If you sell that underperforming investment before December 31st, you can use that loss to offset any capital gains you made elsewhere. Now, let's say you also sold a different stock this year, but you made a $5,000 profit. Normally, you'd owe capital gains tax on that $5,000. But if you harvest a $5,000 loss from that underperforming investment, those two cancel each other out. Your taxable gain, 0. Your tax bill, way lower. And here's the bonus. If your losses are greater than your gains, you can use up to $3,000 of those losses to offset your ordinary income, meaning the money you made from your job. And if you still have losses left over after that, you can carry them forward to future years. Think of it like pruning your financial garden. You're cutting away the dead branches, the investments that aren't serving you, so the healthy ones can grow even stronger. And in the process, you're reducing your tax bill. Now, a couple of caveats. One, we don't want to sell all the time at a loss, right? We're breaking the cardinal rule of investing there. The cardinal rule of investing is buy low, sell high. If we're selling solely for the tax harvesting, we're then selling low. So we want to be aware of that. But again, for the purpose of taxation, tax loss harvesting could be very powerful. Also, the IRS is not going to let you get too clever without some rules. So first, tax loss harvesting only works in taxable investment accounts. It doesn't apply to retirement accounts like your 401k or IRA because those accounts are already tax advantaged. You're already getting tax benefits there. You're not paying taxes on gains or losses in those accounts until you withdraw that money in retirement. And second, this is a big one. You need to watch out for something called the wash sale rule. This rule says that if you sell an investment at a loss, you can't buy that same investment back or something, quote unquote, substantially identical within 30 days before or after the sale. If you do, the IRS disallows that loss and you don't get the tax benefit. Now, here's the thing. To just avoid the wash sale, don't buy something similar. That's the easiest thing. So let's say you sell stock A at a loss on December 20th. You can't buy stock A again until at least January 19th. You can, however, buy a similar investment, like a different stock in the same industry or a fund that tracks a similar index. You just can't buy the exact same thing. I know it's a little annoying, but it's worth paying attention to because violating the wash sale rule means you lose the tax benefit entirely. So you lose the tax benefit and you had a loss on top of it. Here's another thing I want to mention. Tax loss harvesting isn't about giving up on investing. It's not about selling everything and running for the hills. It's about being strategic. You're selling investments that aren't working, capturing the tax benefit, and then reinvesting that money into something better. It's a tactical move, not an emotional one. If you're listening to all of that going like, Shari, there's no way I can do any of that. Like that sounds way too complicated for me. That's fine. Work with a professional. Work with a CPA or financial planner to help you navigate some of these tax benefits to your advantage. So here's your action step for smart move number 2. If you have a taxable brokerage account, review your portfolio before the end of the year. Look for any investments that are sitting at a loss. If you are planning to sell them anyway, now's the time to do it. But if you just want to no, I'm not comfortable with this, hold on to it. Hold on to it. But again, know that you could use those losses to your advantage. If you're not sure how to navigate the wash sale rule or which investments to sell, like I said, talk to a financial advisor or use your brokerage's tax loss harvesting tools. A lot of robo advisors can do this automatically. But again, you can turn a negative, literally a loss, into a positive by taking advantage of the tax loss harvesting. So just don't let your losses sit there and feel bad about themselves. Put them to work. Okay, smart move number 3 is all about generosity, but strategic generosity. Because here's the thing. Giving to charity is beautiful. It's meaningful. It's one of the best things you can do with your money. But if you're going to give anyway, why not do it in a way that also reduces your tax bill? You're not being greedy. You're being smart. And honestly, when you save money on taxes, you have more to give in the future. So this is a win-win. Let's start with the basics. If you donated to a qualified charity, and by qualified, I mean a 501c3 nonprofit organization, you can deduct that donation on your tax return. But there's a catch. You have to itemize your deductions for this to work. Now, a lot of people take the standard deduction instead of itemizing because the standard deduction is pretty generous. For 2025, it's $15,000 for single filers and $30,000 for married couples filing jointly. So unless your totaled itemized deductions, which include charitable giving, mortgage interest, state and local taxes, and medical expenses, exceed those $15,000 or $30,000 amounts, you're probably better off taking the standard deduction. But again, I am not an accountant. Please work with an accountant or a CPA to navigate this. This is just food for thought for you. But here's where it gets interesting. There's a strategy called bunching, where instead of giving small amounts every single year, you bunch multiple years worth of donations into 1 year. This allows you to itemize in that year and claim the deduction. And then in the following years, you take the standard deduction. The easiest way to do this, a donor advised fund. So here's how it works. Let's say you normally give $5,000 a year to charity. Instead of giving $5,000 this year and $5,000 next year, you contribute $10,000 to a donor advised fund this year. You get the full $10,000 tax deduction right now. Then, over the next 2 years, you distribute money from the donor advised fund to your favorite charities whenever you want. It's like a charitable savings account. You get the tax benefit up front, but you still control when and where the money goes. Here's the key. You have to actually keep receipts and documentation. The IRS requires proof of your donations, especially for amounts over $250. So if you're giving to charity this year, make sure you're getting a written acknowledgement from the organization. Most nonprofits will send you a receipt automatically, but if they don't, ask for one. They're totally used to it. They'll send one, no problem. And one more thing, make sure the charity is actually qualified. Not all organizations count as tax-deductible charities. You can check on the IRS website using their tax-exempt organizations search tool. Just type in the name of the charity and it'll tell you if it qualifies. Here's your action step for smart move number 3. Choose one cause you care about, something that genuinely matters to you, and make a planned donation before December 31st. If you're thinking about giving more than usual, look into opening a donor advised fund. Generosity doesn't have to mean financial chaos. You can give in a way that multiplies your impact for the causes you care about and for your own financial future. All right, smart move number 4 is one that makes me want to shake people by the shoulders every single year because so many people miss this. It's simple. Use your benefits before you lose them. I'm talking about FSAs, flexible spending accounts, and HSAs, health savings accounts. I'm talking about deductibles you've already met. I'm talking about vision and dental coverage you've been paying for all year but haven't used. Let's start with FSAs because this is the big one that trips people up. An FSA, again, flexible spending account, is a pre-tax account where you can set aside money to pay for medical expenses. The catch? Most FSAs operate on a use it or lose it basis. If you don't spend the money by December 31st, it disappears. Poof, gone. Now, some employers offer a grace period or allow you to roll over a small amount, usually up to $640 into the next year, but many don't. So if you've got $500 sitting in your FSA and you don't use it, that's $500 you're just handing back to your employer. So what do? If you think you have an FSA, one, you need to confirm it. Log into your FSA account right now and check your balance. You can also access your FSA through your health insurance through your employer. If you've got money left, start thinking about how to use it. Do you need new glasses? Book an eye exam and order those frames you've been eyeing. Do you need to stock up on contact lenses? Now's the time. What about the dentist appointment you've been putting it off? Schedule it before the end of the year. There are so many items that are FSA eligible. We're talking sunscreen, pain relievers, Band-Aids, menstrual products, even certain skincare items. So check your FSA provider's website for a full list and then go shopping. You've already paid for this coverage. You're just getting your own money back. Squeeze every drop out of it you can because, again, you're contributing to this account pre-tax. So it's coming off of before you're paying taxes on your income, your contributions to your FSAs are going there first. So it's your own money coming back to you. You're just not paying taxes on it. So now let's talk about HSAs, health savings accounts, because these are a totally different beast. And honestly, they're one of the best kept secrets in personal finance. An HSA is only available if you have a high deductible health plan. But if you do have one, it's like a financial superpower. 3, 2, 1. It's like a financial superpower. Here's why. HSAs have triple tax advantage. One, your contributions are tax deductible, meaning you are not paying taxes on that money. It comes out pre-tax of your income. 2, the money grows tax-free. And 3, as long as you use it for qualified medical expenses, your withdrawals are tax-free too. That's 3 layers of tax benefits. It's basically a retirement account disguised as a health account. Unlike an FSA, HSA funds don't expire. They roll over year after year. You can even invest the money and let it grow, just like you would in a 401k. In fact, a lot of people use HSAs as a stealth retirement account. They pay for medical expenses out of pocket, let the HSA grow, and then tap into it in retirement when healthcare costs are inevitably going to go up. So here's your action step for HSAs. If you have one, make sure you're contributing enough to take full advantage of it. The 2025 contribution limit is $4,300 for individuals and $8,550 for families. And if you're 55 and older, you can contribute an extra $1,000. If you've got unused HSA funds sitting around, consider investing them instead of just letting them sit in cash. Most HSA providers offer investment options just like a brokerage account. Now, one more thing before we move on: deductibles. If you've already met your health insurance deductible this year, meaning you've hit that threshold where your insurance starts covering more of your costs, this is the time to get stuff done. Book that physical therapy appointment, schedule that surgery you've been delaying, get that MRI your doctor recommended, because come January 1st, your deductible resets and you're starting from scratch. Here's the bottom line: if you've already paid for your coverage, whether it's an FSA, HSA, or your regular health insurance, don't let it go to waste. You've earned it. Now use it. All right, we've covered some big moves, but before we wrap up, I want to hit you with a rapid fire list of a few other year-end tax strategies that might apply to you. These are the bonus moves, the ones that might not apply to everyone, but if they do apply to you, they can save you some serious cash. Number 1, energy efficient home upgrades. If you've made energy efficient improvements to your home this year, like installing solar panels, upgrading your HVAC system, or adding insulation, you might qualify for federal tax credits. The Inflation Reduction Act expanded these credits big time. So if you've been thinking about going green, now's a great time to do it. And if you've already done it, make sure you're claiming the credit on your tax return. Number 2, 529 plan contributions. If you live in a state that offers a tax deduction for 529 college savings plans contributions, make sure you're taking advantage of it before December 31st. Not every state offers this, but more than 30 do. So check your state's rules and see if you can squeeze in one more contribution before the year ends. Number 3, small business or side hustle deductions. If you're self-employed, have a side hustle, or run a small business, there are tons of deductions you might be missing. Home office expenses, equipment purchases, software subscriptions, mileage, even that new laptop you bought for work. The key is to keep good records and make sure you're tracking everything. If you've been slacking on bookkeeping this year, now is the time to get it together. And if you've made any big business purchases this year, you might be able to take advantage of Section 179 expensing or bonus depreciation to write off the full cost in 1 year instead of depreciating it over time. Number 4, estimated tax payments. If you're self-employed or have income that doesn't have taxes withheld, like rental income, freelance work, or investment gains, you might need to make estimated tax payments. The final quarterly payment for 2025 is due January 15th, 2026. But if you want it to count for this tax year, you pay it early before December 31st. This one's a little tricky, so I'd recommend checking with a CPA or using tax software to calculate what you owe. But don't skip it, because if you underpay your estimated taxes, you could face penalties. All right, that's the rapid fire round. Again, not all of these will apply to you, but even if one does, it's worth looking into. And as always, when in doubt, or if you have any questions, or trying to go at this at all, check with your CPA or your tax software before year end. They'll help you figure out what applies to your specific situation. All right, let's bring it home. We've covered a lot of ground today. So let's do a quick recap of the big 5 smart 3, 2, 1. Let's do a quick recap of the smart money moves you can make before December 31st. Smart move number 1, max out your retirement accounts. Whether it's your 401k, your IRA, those pre-tax contributions are going to lower your taxable income and set you up for a better retirement. Even if you can't max out completely, increase your contribution by just 1% or 2% before the end of the year. Smart move number 2, harvest your losses. If you've got underperforming investments in a taxable account, sell them before December 31st and use those losses to offset your capital gains. Don't let those losses just sit there, put them to work. And again, this is where your accountant, CPA can really help you with this. So reach out to them and ask them the best course of action. Smart move number 3, give smarter. Charitable giving is beautiful, but do it strategically. Use donor advised funds to bunch your donations and make sure you're keeping records for everything. Smart move number 4, use your benefits before you lose them. FSAs expire on December 31st for most people, so check your balance and spend it. And if you've met your health insurance deductible this year, schedule those appointments now before everything resets in January. And don't forget the bonus moves, energy efficient home upgrades, 529 contributions, small business deductions, and estimated tax payments. Here's the empowering takeaway I want you to remember. This isn't about gaming the system. This isn't about doing anything shady or unethical. This is about keeping more of what you've earned, the money you worked hard for, and making sure it's working for you, not just disappearing into the black hole of the IRS. You've got a few weeks left before the calendar flips. Don't waste them. So here's my call to action for you. Pick one move from today's episode, just one. It could be increasing your 401k contribution. It could be scheduling that dentist appointment to use up your FSA. It could be donating to a cause you care about. Whatever it is, commit to it before December 31st. And then I want to hear from you. Tag me on social media at Everyone's Talking Money and tell me your smart money move. I want to celebrate with you, and I want to see what you're doing to take control of your financial future.